Risk is the uncertainty regarding future outcomes and the possibility that actual results may differ from expectations. In financial planning, risk encompasses the potential for financial loss, reduction in purchasing power, liability exposure, property damage, health-related expenses, disability, premature death, and other events that may adversely affect a client's financial well-being. Risk management seeks to identify, measure, and address these uncertainties before losses occur. Because risk cannot be completely eliminated, financial planners help clients develop strategies to manage exposures in a manner consistent with their goals and resources. Effective risk management protects accumulated wealth, preserves financial stability, and supports the achievement of long-term financial objectives. The principles of risk management begin with understanding the nature and characteristics of risk. Pure risk involves situations where outcomes result only in loss or no loss, such as accidents, illnesses, or property damage. Speculative risk involves the possibility of both gains and losses, such as investments or business ventures. Insurance primarily addresses pure risks because they are measurable and insurable. Risk management also considers the frequency and severity of potential losses. High-frequency, low-severity losses may require different treatment than low-frequency, high-severity events. Understanding these distinctions allows financial planners to recommend appropriate strategies that balance protection, affordability, and overall financial efficiency. Insurance serves as one of the most important risk management tools available to individuals and families. Insurance operates through the principle of risk pooling, whereby many policyholders contribute premiums to a common fund used to compensate those who experience covered losses. This mechanism transfers financial risk from individuals to insurance companies. By exchanging uncertain and potentially catastrophic losses for predictable premium payments, individuals gain financial protection and peace of mind. Insurance does not prevent losses from occurring. Rather, it reduces the financial consequences when losses arise. Common forms of personal insurance include life, health, disability income, long-term care, homeowners, automobile, and liability coverage. Several fundamental principles support the functioning of insurance. The principle of indemnity seeks to restore an insured party to the approximate financial position occupied before a loss, without creating profit from the claim. Insurable interest requires that the policyholder suffer a genuine financial loss if the insured event occurs. Utmost good faith requires both insurer and insured to disclose material information honestly and completely. Subrogation allows insurers to recover losses from responsible third parties after paying claims. These principles help maintain fairness, reduce fraud, and ensure the long-term viability of insurance systems. Financial planners must understand these concepts when evaluating policy structures and coverage recommendations. Risk management generally follows a systematic process consisting of risk identification, risk measurement, risk treatment, implementation, and monitoring. Risk identification involves recognizing potential threats that could affect financial goals. Examples include death, disability, illness, property loss, liability claims, unemployment, and long-term care needs. Once identified, risks are evaluated based on their likelihood and potential financial impact. This assessment enables planners to prioritize exposures and focus attention on the most significant threats. A structured risk management process ensures that clients address vulnerabilities proactively rather than reacting after losses occur, thereby improving overall financial security and resilience. Analysis and evaluation of risk exposures represent critical steps within the risk management process. Financial planners assess both personal and financial risks affecting clients and their families. Personal risks include premature death, disability, health concerns, longevity risk, and dependency-related obligations. Property risks involve potential damage to homes, vehicles, and personal belongings. Liability risks arise when individuals may be legally responsible for injuries or damages suffered by others. Financial risks can also include loss of income, inadequate emergency reserves, and insufficient insurance coverage. Comprehensive evaluation requires consideration of the client's age, health, family structure, occupation, assets, liabilities, and future financial obligations. Quantifying risk exposures involves estimating both the probability of loss and the magnitude of potential financial consequences. Financial planners often analyze existing insurance policies, income replacement needs, debt obligations, asset values, and future financial commitments. For example, life insurance needs analysis may evaluate family living expenses, education funding requirements, outstanding debts, and survivor income needs. Disability insurance assessments consider income replacement ratios and expected recovery periods. Property and liability evaluations examine replacement costs, legal exposures, and policy limits. These analyses help determine whether current protections are adequate and identify areas where additional coverage or alternative risk management strategies may be warranted. The ultimate objective of risk exposure analysis is to develop a coordinated strategy that protects clients against significant financial loss while maintaining cost efficiency. Risk treatment methods generally include avoidance, reduction, retention, and transfer. Insurance serves as the primary transfer mechanism for many significant personal risks, while risk reduction strategies may involve safety measures, diversification, and preventive planning. Some risks may be retained when potential losses are manageable and self-funding is economically reasonable. Through comprehensive analysis and evaluation of risk exposures, financial planners help clients safeguard their assets, income, and financial goals. Effective risk management strengthens financial stability and creates a secure foundation for long-term wealth accumulation and financial independence.